Well, hello everybody, it is Jake of Nordby back with you here, and you know what, I have been promising to do some updates for you on what exactly is going out there in the world of mortgage rates. And you know, what's really interesting right now is that there, as you know, is a very high level of intervention from the government in the rate world. In other words, the Federal Reserve Board has approved direct purchasing of mortgage-backed securities. That drives the price up. It means there's more competition for it. That drives the yield or the rate down. And so what the papers and the television are reporting all over the place is record low mortgage rates. And in fact, that is true. However, there are some factors that make it really hard for people to sometimes capture the very bottom of those low rates when it comes to the retail rate market. And so what I wanted to do was kind of pull the curtain back a little bit and show you some things on an actual rate sheet. This is something that people don't usually do, so I want you to know you're kind of in my inner circle. You get this access, and just so you know, this is not a rate quote. This does not meet the guidelines, the RESPA guidelines and truth in lending guidelines for a rate quote. So don't look at this as me quoting you a rate. I'm just going to show you how rate quotes actually work and why they're just a little bit wacky right now. So we're going to go to a screencast here so you can see exactly what I see every day when I'm trying to figure out how to quote people rates and what's going to be fair and what's going to treat them the best. So come with me and we'll take a look. Thanks a lot. When it comes to having an opinion about the market and what's going to happen and what's been happening and all of that, I use specialty tools. This one's called Mortgage Market Guide, and again, I'm kind of letting you peek behind the curtain right now and see exactly what I see and how I form opinions and get some idea of what we should do. And so again, this is one of those pages. You can see I get streaming stock quotes and news that come through, and also the page I wanted to show you here was these are the various pools of mortgage-backed securities. These are the Fannie Mae 30-year mortgages, and these are the wholesale rates. All right, 4.0, 4.5, that's the rates that the lenders are basically packaging up and selling off to Fannie Mae or Freddie Mac, in this case Fannie Mae. And then the Ginnie Mae pools, these are the different ones where they're selling it to, those are the government-backed security, and the government ones like VA and FHA. And so it just gives you an idea, like many other financial markets, the rate market, the mortgage-backed market, moves up and down constantly, and what buyers and sellers are willing to pay each other for these various securities changes constantly as well. And so this service gives me some predictive knowledge, looking forward in the future and saying this is what is likely to happen and here's why. So again, I'm just helping you understand some of the tools I use in my toolkit to produce both an opinion and information that you need to make decisions. Let's move on now and show you how I actually build a rate, a price quote itself. A big part of the price quote, and the reason why rates can vary quite a bit from borrower to borrower and from property to property, is that there are all sorts of different things that can affect it. And for example, we have the loan amount itself that can affect it. So the smaller the loan amount or a really, really large one can sometimes, cause something of a variation there. I'm just going to put in some general terms here, and we'll just call this one a rate and term refinance. A lot of people are doing those right now, and the name doesn't matter right now, but let's put in a really, a decent credit score, 680. Obviously anything over that is good too, but we'll start there. And standard terms here, so a decent credit score, not absolutely the very top, but good and solid credit score, a low debt to income ratio. Anything over 41, 42 and north doesn't mean we can't get it done, but the higher the debt load compared to the income that comes in, that can make a pretty big difference, whether they're self-employed or not, whether they're a first-time buyer. There's a variety of other things that can actually play in here. And so again, if it's a primary residence or a second home or investment property, those all go in and can make major differences in what gets charged. Conforming loan, non-conforming is basically out of the window at this point. FHA, VA, or rural development, a variety of things like that. We'll just go ahead and put FHA here. 30-year fixed, the various other options. Fixed rate arms, balloons, or option arms. Again, right now fixed rates are almost the only game in town, and that's about that. So we're going to go ahead and hit submit here, and we'll actually tell you now exactly how these rates are built on the back end, and how it gets priced for the street. In other words, if you walk into a mortgage company, how they are pricing it and how they're actually making money. So the program's done a quick search and spit out some of the different lenders that my company works with, and we work with them as a true banker, meaning we fund the loans and then it's packaged up and sold off to these companies after the fact. And so these are some of the ones, and we get to choose between them and decide, which ones are going to, give both the best price and also the best service, and underwriting guidelines can be varying between them as well. So let's just take a quick look here at, these are sorted by price. I tend to see a lot of these going to Wells Fargo lately. They generally are toward the top. Right now, apparently, they have shifted just a bit. And here's the interesting thing as we're looking at some of these pricing scenarios here, is that what you're seeing on the TV or reading the newspaper about these record low rates, like just amazingly low rates, well, one thing that a lot of people aren't being told right now is that because these great big lenders came under such duress as the economy has slowed down, many of them made massive layoffs to their staff. Well, now that through some outside factors like the Federal Reserve buying up mortgage-backed securities and various other factors, the inflation rate going the other direction where it actually looks more like deflation for a while, the mortgage rates have actually come way down again, like historically down again. And so they really can't control the fact that lots and lots of people want to refinance their houses. The trouble is they have this enormous rush of new people coming to apply, both through, so if you go into Wells Fargo, you just walk into a Wells Fargo branch and apply for a loan. Or if you come to a mortgage company like mine and you apply for a loan, and we're putting it through Wells Fargo, suddenly they have this enormous bottleneck, this huge backlog of new business to take care of, and they really don't have the staff for it. So what can they do? Well, what they can do is essentially raise the price on these loans. So basically what you are seeing here is, again, kind of a sneak peek, kind of behind the curtain, and this does not, I'm going to say it again, this does not constitute a rate quote. So you can't take this and run with it as a rate quote. I would actually not be in compliance by showing you this if I were just showing you this to quote a rate. But I'm just showing you how we build these as a scenario, hypothetical scenario. So basically, there's the wholesale cost of money, and then there's the retail cost of money, the price that goes out to the street, and in the middle of that is the profit margin. All right, well, there's all sorts of different ways of pricing loans, and many people will price them. If you in Boise, Idaho, up and down the street, a lot of times we're pricing those with about 1% that's coming back from the lender. So in this case, Wells Fargo. And anything here with a negative number, so under 100%, that actually means we have to pay to get the consumer that rate. So here's 4.5%. All right. Well, you can see that on a 30-day lock, that's going to cost us almost 2%. So 1.7-ish% will get us to what's called par. And in the world where we're actually selling that loan off, that means we have not yet made a penny of profit to get to 4.5% if we charge the customer 1.7 points. And just a refresher, 1% of the loan amount is 1 point. So if it's a $200,000 loan, we're talking about, almost $4,000, $3,500 or so to get there, not quite that. And so, you look at that, and so if we're at 5%, the rate's at 5% on a 30-day lock, well, suddenly we're at 0.324, so a very, very small sliver of money here on this FHA loan would be being paid to me, to my company rather, if we were pricing that loan at 5%. So, obviously we have to pay the bills and make a living, so we'd probably have to price in at least a 1% origination fee to get to that. And frankly, it's more competitive to be being paid just about 1 to 2% from the lender. And so really, if I were pricing this FHA loan today on the street, I'd probably have to charge about 5.5% as a rate and charge a 1% origination fee to meet our normal profit margins, which is about 2% of the loan amount constitutes the profit margin that a mortgage company and banks, generally speaking, make at least that, sometimes more. So that's how that part of it works. So I need to wrap up here and just kind of give you the opinion. So at the moment, what we're looking at is really pricing is a little tough to come by what would be known as just the absolute bottom of the market at the moment. And part of that has to do, as I said before, with just the volume trying to run through these big lenders and trying to get it all, in the pipeline right now. So I guess what I'm going to just say is that if you're on my hot list, and I want to invite you to be on my hot list, send me an email to the what you're seeing on your screen there, and I can put you on my hot list. And as rates and the market and the environment improve, or shift. So if it starts going the other direction rapidly, we'll know that, as you can see, ahead of time. And if that happens, I just think it's important for you to be able to make a decision based on real facts. But before you make any kind of a move out there with some of these online banks or the ones who just promise the super low rates, if it sounds way too good to be true, it probably is costing you money somewhere that you might not be aware of right up front. So again, thanks for watching this, and we'll talk with you soon.